Since March, the United States has witnessed three of the largest bank failures in its history: Silicon Valley Bank, Signature Bank, and New Republic Bank, with combined assets worth over $500 billion. This amount is roughly equivalent to the assets of the 165 banks that failed during the 2008 financial crisis. In response to these failures, the Federal Reserve has taken action, injecting emergency liquidity into the banking system and reversing months of quantitative tightening. Amidst these events, commentators have raised concerns about the Federal Reserve's position. On one hand, the Fed must infuse reserves into the banking system to prevent a financial crisis. On the other hand, such measures could undermine their ability to address historically high inflation. However, these concerns may be overstated for two key reasons. Firstly, monetary stimulus, in the form of emergency lending, does not typically have the same impact on the economy as other monetary measures. The purpose of emergency loans is to assist banks in meeting deposit outflows and prevent them from liquidating assets at fire sale prices, which could trigger a financial crisis. In this scenario, the borrowed reserves are used to address depositors' withdrawals, rather than increasing the broader money supply and fueling inflation. In fact, the absence of such emergency liquidity could potentially lead to deflation rather than inflation. Secondly, the Federal Reserve's operating framework reduces the impact of reserve changes on the broader money supply. Suppose multiple banks simultaneously face illiquidity due to unexpected deposit outflows and are unable to borrow reserves from other banks. The Fed can step in as the lender of last resort and provide emergency loans through the discount window, granted the banks have adequate collateral. By doing so, the Fed prevents a potential financial crisis. It's important to note that the Fed cannot directly control how banks use the funds acquired through the discount window, but by setting the discount rate sufficiently high, the incentive for banks to use it as a source of loanable funds is minimized. Moreover, the current framework, which includes interest on reserve balances, influences banks' lending incentives. Unlike before 2008, when the Fed did not pay interest on bank reserves, banks now have a greater incentive to hold excess reserves, as the return they receive from the Fed outweighs potential earnings from lending. As a result, the money multiplier, which determines the impact of reserves on the money supply, has declined since 2008. The Fed can still provide liquidity to the banking system while simultaneously reducing the incentive for banks to make loans by adjusting the rate it pays on reserve balances. This allows the Fed to have more control over the money multiplier and mitigate the trade-off between liquidity provision and price stability. However, it's important to note that increasing the reserve amount will still have an impact on the money supply, albeit to a lesser extent than before. While the current framework has its downsides, such as substantial losses for the Fed and a larger role in credit allocation, it offers the ability to combat inflation without risking a financial crisis. Policymakers must carefully navigate these challenges to ensure the stability and efficiency of the financial system. Subscribe Libertarian Facts.